Now, let's start looking at some of the changes that came in the Basel post the Basel 2 version. Typically, by the time the Basel 2 got completely implemented, almost the 2007-9 financial crisis has started. Right? Completely, by the time it got completely implemented, we see that the financial crisis has come up, and that is where there are lots and lots of critics who started criticizing Basel 2 purely because it has offered the banks a flexibility in terms of using internal rating based approach IRB to calculate the credit risk, right? That flexibility to calculate the credit risk, the banks were relying more on their own estimates of computing the probability of default, the loss given default, or even computing the exposure at default. And it looked more and more that this is a mechanism that is acting more like a self-regulation for the bank, and these self-regulations were perceived that the banks were underestimating the risk because of this particular reason. Banks ended up in underestimating the risk because they had the flexibility, and they have literally got into over lending kind of a process. Now, this has been the major criticism regarding the Basel 2 because it was linked more or less closely with the financial crisis. And this is where Basel committee really thought that there need to be a change in the way, at least initially started off with the market risk based capital. The way the market risk based capital is computed, they wanted to bring about a change in it. And this specifically with only the changes relating to the market risk based capital, they have incorporated as a part of Basel 2.5, and they have released it. If you remember, as a part of the typical Basel 2, if I have to recollect what is the capital that the banks have to set aside towards the market risk, it was talking about a maximum of either the previous day's VAR or some multiplication factor times the average value at risk over the last 60 days. Now, both these VARs, whether it is this or this, it is computed on a 10-day time horizon basis, right? It is computed based on a 10-day time horizon basis with 99% confidence level. So either it is the previous day's value at risk or the historical last 60 days average value at risk multiplied by a multiplication coefficient whose values could be anywhere between 3 to 4. 3 very close to 3 when the typical backtesting of the same has resulted in very minimal exceptions, less than 5 kind of exceptions when it was being backtested over the last 250 days. Then they can use a multiplication factor of 4, but if the number of exceptions are increasing, then the multiplication factor should go up to 4. That used to be the earlier mechanism for computing the market risk capital charge for the Basel 2.5. Now here To address this concept of market risk capital as a part of Basel 2.5, the Basel committee has actually come out with three major recommendations. One, every bank, apart from computing the regular value at risk using the earlier mechanism, it is also talking about the computation of stressed value at risk. Right? We will talk about it. There is a computation regarding the stressed value at risk, and there is a new IRC that has been come up, which is nothing but incremental risk charge. So, which is an additional charge that has been brought about. And the third thing which has been focused upon is a comprehensive risk measure, CRM, which is majorly applicable to those instruments which are very much sensitive to the correlation between the default risks, which are primarily based on correlations of default risks of the various instruments. So this is where a comprehensive risk measure has been brought about. So if we get started with the stressed value at risk, recollect the Basel 2. What is the way it was computing? What is the way it was computing the value at risk? It was using a historical simulation kind of a procedure. Fair enough. Right? It was using a historical simulation mechanism, and the VAR that is computed through this historical simulation was traditionally used for the computation of the market risk capital charge. And in a historical simulation, the way it was executing is the percentage change for that particular variable, let's say for tomorrow, the way it is estimated is based on the last 4 years, right? 1 to 4 years data based on the changes in the last 1 to 4 years. I was taking some 250-day period, 1 year to 4 years. Some kind of a data during that particular period has been taken, and the computation for the value at risk has been done. Now here, probably if they had used the last 1 year or last 4 years, it's just the percentage changes that have come, and on that probably a random sample of 250 days. Let's say the last 4 years data has been taken. So probably around 1000 points would have been there, assuming 250 trading days. Out of them, 250 on a random basis have been taken out, and out of that 250, probably the 1% VAR has been computed, which is what is the resulting scenario. But now what it is simply saying is, this mechanism, probably before the crisis, the volatilities were much lesser, which means the price fluctuations were much lesser. So because of that, the value at risk, if I am computing based on the pre-crisis data, even of the 4 years data pre-crisis, the value at risk was much lesser. So if I assume like 2003 to 2006, when the volatilities were lesser, even in 2007 when I am computing, it's a random sample from 2003 to 2006. Even if I am looking at 2008, it could be a random sample between 2004 to 2007. So there are 2-3 years where it was not volatile. It was very much stable. Only 1 year where there was a fall. So what has happened is, even the estimates of 2008 and 2009, the VAR was representing a smaller number itself because of the historical simulation method that has been used, wherein it was a mere random sample of 250 days over the last 4 years kind of a period, right? So at least after some time after the financial crisis started also, the war was giving much lesser kind of an estimate. That is where the Basel 2.5 thought probably something has to be changed as a part of the calculation, and that is where they said apart from the regular VAR that is getting computed, the banks are also necessary to compute the stressed VAR. So in the stressed VAR, they take the 250 days, they take the 250 days period where the market is very much stressed. A 250-day period where their portfolio has really performed the worst. So they take that 250-day period where the portfolio has performed the worst, and within that period they are computing the VAR and they are using it as a stressed VAR. Now because of this reason we could see that different banks will have a different formula for stressed VAR because the time periods are different for different banks. They had to really identify which 1 year period has really resulted in a drastic loss for them, and they have to include that specific time period for the computation. Now once they have computed the stressed VAR, again the computation is on the same lines as the VAR itself. So they are still going with a maximum of S VAR T minus 1 plus some multiplication factor times S VAR average. So again the same mechanism, but this is traditionally added to the regular VAR that they have computed, a maximum of VAR T minus 1 plus MC times VAR average. Now the only difference being these weightages. Again, these weightages are very much linked to their historical experience, which are determined by the supervisors, and they are purely based on the back testing of the model. The more are the exceptions, the higher is the weightage, the lesser the exceptions, lower is the multiplication factor, but traditionally this factor is anywhere between 3 to 4. And this summation was what is coming out for the total capital charge corresponding to the market risk. The banks are supposed to compute that on a regular basis. And now if we clearly see, first of all, this stressed VAR definitely will have a value greater than that of the regular VAR. Because here this is a random 250, whereas this is a specific 250. So this value will always be greater than this value, which means if I have to look at the capital requirement under the Basel 2.5, definitely the capital requirement is more than double compared to what the traditional Basel 2 has suggested for towards the market risk capital charge. So it is expected that the Basel 2.5, which has focused on the stressed VAR and alterations to the market risk capital charge, could really bring down the risks that are inherent with respect to the market risk, right? Now let's move on to the next one, which is the incremental risk capital charge. Otherwise, we are calling it as IRC. Now, before the crisis, if I look at from a typical bank's perspective, there is a trading book as well as a banking book. So different assets are typically held for trading purposes. The bank would have got into bonds, equities, right? Any kind of commodities, or probably any other derivatives which are held purely for the trading purpose. They are all kept as a part of the trading book for the bank. Similarly, when I talk about the banking book, it is primarily containing the loans and any kind of long-term debt that the typical issued. So all these assets which are primarily from the investment purpose, they go as a part of the banking book, right? Now try to understand as a part of the Basel 2, what was the value at risk for this? This was looked purely from the perspective of credit risk, right? And for this, the typical value at risk computation was first of all on a 1 year time horizon, and 99.9% confidence level VAR was computed. Whereas here it was for a 10-day time horizon, 99% confidence level VAR, and of course this is some kind of a multiplier that has been done on the top of it. So in general it looks like this value is much lesser compared to the value at risk that is applied on the banking book. And there are a lot of places where typically the banks had used a mechanism where they can very comfortably convert their banking book into a trading book. Probably see the loans which they have initiated, they have securitized them, and that entities who have really, so when they have securitized, the loan is moving away from their banking book, and once they have securitized it, that third party which has got into the securitization, it has typically issued the bonds out of it, and the same bank, whether it is bonds or ABS or whatever it is, so the same banks have really invested in the ABS and the CDOs of those particular of those particular instruments, which means they have converted their banking book literally into a trading book, and the capital charge for the trading book is much lesser compared to that of a banking book. This is where a requirement came out, especially trying to come out with what is called as an increment default risk charge. Initially, they came up with this term as incremental default risk charge, where the banks were supposed to look at 99.9% confidence level, 1 year VAR computation for those instruments even which are there in the trading book, especially if they are sensitive to default risk. If you see the derivatives and all where they are more and more sensitive to the default risk, it says that even these instruments you have to compute the value at risk based on 99.9% confidence level for a 1 year time horizon, which has increased the capital charge that is associated even with these kind of instruments. So probably now the difference is slightly getting narrowed between the trading book instruments which are sensitive to credit default versus a typical banking book instrument. But if you see, the name created a problem. Majority of the problems that came up, majority of the losses that came up during the latest financial crisis, they were not because of the default. They were primarily because of the liquidity crisis that has come out. None of them have defaulted heavily, but the downgrades have happened heavily. The credit ratings were created as a problem. The credit spreads got widened. Now all these things have really brought out the losses. That is where the Basel committee thought, instead of naming it as incremental default risk charge, let's put it as incremental risk charge itself. Now this is where the focus moved, not just from the sensitivity to the default risk, but also the banks are supposed to measure the sensitivity towards the downgrading risk as well. The ratings getting downgraded, the banks have to really look at the sensitivity of their portfolio with respect to the rating changes as well. And they have to rebalance their portfolio at a regular intervals of time. This is where some interesting part has come out. Okay, for each of the instrument, probably let's say they are looking at a AA rated instrument. For each instrument, they have to look out for a liquidity horizon. Typically, Basel has recommended a liquidity horizon of 3 months, but of course, it can be 6 months or even 9 months. For every investment in the trading book which is sensitive to credit risk or downgrading risk, the bank has to typically choose a liquidity horizon. Now, what they have to do based on this is, okay, if they have chosen it as 3 months, they have to watch it at the end of 3 months. That particular instrument they will watch at the end of the liquidity horizon. Let's say either that particular bond has defaulted or ratings might have got downgraded. Now, if at all any of this thing has happened, the bank has to do a replacement. That is where the rebalancing comes into picture. It has to replace that particular asset with an equivalent asset which is comparable to this AA rating at the beginning of the period, not at the end. There is a small loss that is incurred because of the credit downgrade, but obviously it is not resulting in full default. So you are basically taking a necessary action at the earliest itself rather than waiting for total default to typically occur. So this exercise is being performed at the end of every liquidity horizon, and that is where it's like a cautious approach in terms of identifying the problem at an earlier stage and taking a quick measure in terms of addressing that. And this kind of an assumption where they are actually going into the rebalancing every stage is what we are calling as constant level of risk. So they are trying to maintain a constant level of risk by rebalancing it. So because of this kind of a move in, there is a possibility that there is some amount of loss that is occurring, but the overall probability of default is drastically reduced, which means the 1 year value at risk, which is measured at a 99% confidence level, this number will go down drastically. And anything to do with the credit spreads, the specific risk charge SRC is computing what should be the typical charge that is associated with the credit spread. So the incremental risk charge was adding one more level of protection against the losses that are coming up, especially with the instruments which are there as a part of the trading book of the company, but which are more and more sensitive to the credit, either the default risk sensitive or getting exposed to at rating downgradation kind of stuff, right? So this is one more new thing that came as a part of Basel 2.5. Then moving a bit more ahead, there is something called as comprehensive risk measure. The third thing which is a part of Basel 2.5 is a comprehensive risk measure, otherwise called as CRM, which is a single capital charge, especially for correlation dependent instruments. majorly, if I'm talking about the correlation dependent instruments, we can talk about the asset backed securities or collateralized debt obligations of the asset backed securities itself. Now, for these, there is a single capital charge. There is nothing called a specific risk charge and incremental risk charge. All these are getting replaced by a single capital charge called a comprehensive risk measures, especially for those kind of instruments or those kind of risks which are a part of the correlation book. So this is where the Basel 2.5 has come one more step ahead in terms of identifying those kind of instruments which are more and more sensitive to the correlation. Because if you look at a typical CDO and let's say a senior tranche in a CDO, in a no, and probably the senior tranche typically will get a AAA rating. And what we generally see is in the market, when the situation is very good, in the normal kind of a market, it's very rare that this tranche will default. So a AAA is very much apt for this. But just like the way we have seen during the financial crisis, this this tranche, because of its correlation with various other instruments, the correlations have widened drastically, and because of that, even these senior tranches had to default. Now, this is where the correlation, they are in normal conditions, they are not exposed to a risk of default. But when the correlations widen, especially during the stressed market scenarios, this is where for them the correlations are going to widen and the risks are going to increase. And to address this, for the rated instruments, especially we are talking about the rated instruments, it wanted to come out with a standardized approach. All the different rated instruments, there is a standardized approach that has come out. And this is where again a bifurcation lies, especially with those instruments which are securitized normally, like your mortgage backed securities, and some of them which are re-securitized, means securitization of a securitization. Probably once an asset backed securities are created, on the top of these various asset backed securities, using the mezzanine tranche of the different asset backed securities, another CDO has been created. So CDOs of the ABSs, they are like re-securitized kind of instrument. So what they have brought out is, for these, the requirement is much lesser, the capital requirement is much lesser. But for these instruments, the capital requirement became much higher. And Basel has simply come out with saying, if at all it's a highly rated kind of a tranche, anything from AAA to AA minus, under a regular securitization scenario, if it is 1.6% is the capital charge, under a resecuritization scenario, it would be double. Similarly, if the tranche is having a rating from A plus to A minus kind, and the remaining A rating, it is 4% and 8%. The more going into a triple B plus to triple B minus, this rating is resulting in 8% and 18% kind of a charge. And finally, double B plus to double B minus kind of a rating resulted in 28% under the securitization, 52% under the resecuritization. And if at all, that particular instrument which is unrated or having any rating that is below double B minus, we are deducting the entire principal amount from the exposure for the computation of capital, which means we are talking about 100% capital charge for those kind of instruments. And this is where some flexibility is also provided. at least for these unrated instruments or unrated tranches, the banks have the flexibility to use their internal model provided there is an approval. So the banks have the flexibility to use their internal model to compute the comprehensive risk measure for those kind of unrated tranches. But this internal model should be more and more rigorous. Lot of stress tests need to be performed. This entire thing has to be approved by the supervisors, and it has to be completely sophisticated in terms of the various rules that it is using. Under these circumstances, the banks have the flexibility to compute it on their own. It has to capture the risk that is associated with the credit spread, any kind of multiple assets that are defaulting, even that has to be captured quite effectively by this model. Implied correlations, whatever are getting derived, the kind of volatility that is lying between the various implied correlations need to be handled, and correlations versus the credit spreads. The model should take this kind of behavior into consideration. Any kind of rebalancings that are typically done, whatever is the cost that is driving this rebalancing. And finally, all the recovery rates. What is the kind of volatility that is associated with the recovery rates? All these things need to be driven as a part of the model for computing the comprehensive risk measure. Then the banks are allowed to typically use their internal model, because on one side, if you are looking at the Dodd-Frank Act, the first thing that they have completely discouraged is don't depend on the credit ratings for setting the capital requirements. Now, if you look at the comprehensive risk measure, it is very much linked with the credit ratings. So this is where the government is trying a little bit more in terms of coming up with its own model. So probably all these inputs can definitely add value towards the building of a very effective model which does not use the credit rating to come out and define a comprehensive credit risk measure. So that is how the Basel 2.5 has emerged, and these are the various aspects that the Basel 2.5 has considered and got implemented somewhere towards the end of 2011. Right? Now, let's look at Basel 3, which is again an improvement over the Basel 2.5. We know that the Basel 2.5 has actually addressed the market risk based capital charge. It has introduced the concept of stressed VaR. It has brought in incremental risk charge, and even to associate the default correlations between the assets, it has even come out with a comprehensive risk measure. So keeping that in mind, when I go towards the Basel 3, it's majorly targeted towards the credit risk per se. And of course, the major focus on it even turned towards the liquidity risk. So the credit risk based capital charge has actually gone up, and even the definition of capital has been very much stricted, right? So the definition of the capital has been very much tightened, and it is said that the tier 3 capital that was there as a part of Basel 1 and Basel 2, it has eliminated the concept of the tier 3 capital. So If I have to look at the clear-cut definition of the capital now, there are only tier 1 and tier 2 capitals. Right? The current definition of the capital contains only tier 1 and tier 2. And within tier 1, we have tier 1 equity capital, and we have additional tier 1 capital, wherein the base or core tier 1, which is the equity capital, it contains only the common equity and the retained earnings of the bank. Whereas when it comes to the additional, it has even brought out the non-cumulative but perpetual preferred stock. So if at all any such kind of instruments are there, they are going as a part of additional tier 1. Remember, this tier 1 should actually do some kind of adjustments also. Any kind of goodwill, it is not included as a part of the tier 1 capital. The exclusions I can very well look at. Anything which is taken as a goodwill needs to be excluded. Any deferred tax assets need to be excluded from the computation. Mean whatever the number is there in the balance sheet and the financial statement, I should make an adjustment or I should take out the impact of these things. Any kind of change that came into the retained earnings because of the securitized transaction, securitization that the bank has done, and this has resulted in an increase in the retained earning, that portion of the capital should not be considered. And similarly, any kind of change in the retained earnings because of the debit value adjustment to an adjustment towards the derivatives transactions, that also resulting in an increase in the retained earnings, all these things should be removed, and whatever is the capital, that is what we are calling as the tier 1 capital. And along with that, if there is any kind of planned deficits, right, if the plan is more, if the defined benefit pension plan is underfunded. What do we mean by underfunded? The plan assets are lesser than the plan limited obligation, right? Whatever the plan obligation is there, that is much more than the plan asset, then we are calling as underfunded. Now this underfunded status, also we are adjusting the capital downwards, whereas we don't adjust it upwards if my planned assets are greater than the obligations that need to be paid under the defined benefit pension plan. And even there are kind of rules that have come out in terms of the capital that has been issued by the subsidiaries and the minority interests. There is a change in the way that all these things need to be addressed as a part of the computation of the tier 1 capital. And now it is a requirement that this tier 1 capital, at least the tier 1 capital, equity capital, it should be at least 4.5% of the total risk weighted assets, and these two put together, it should be at least 6% of the total risk weighted assets. That is a mandatory requirement, right? The tier 1 equity capital, around 4.5% of the risk weighted assets, whereas the total tier 1 capital should be around 6% of the risk weighted assets, right? Now, looking towards the next category, which is the Tier 2 capital, Tier 2 primarily contains the debt. Only that portion of the debt which is very much subordinated, it's not a senior debt, subordinated debt, especially to the depositors, which means the depositors' interests are preserved even when the losses are, even when these people are absorbing the loss. So the debt which is subordinated to the depositors with a maturity of at least greater than or equal to 5 years, that is considered as a tier 2 debt, tier 2 capital. And some forms of preferred stock which are still subordinated to that of the regular debt and still subordinated even to the depositors, that is coming out. The preferred stocks such as cumulative preferred stock and all, they come under your tier 2 capital. And the requirement is, when I am taking tier 1 plus tier 2 both, they should be minimum 8% of the total risk weighted assets. Even in Basel 1 and Basel 2, this requirement was the same. But at a later stage, I am going to pull out that there are two additional things also that are going to get added to this list. We will talk about a capital conservation buffer as well as a counter cyclical buffer, which would typically increase this requirement to a drastic extent. But if I am looking at purely from the perspective of tier 1 and tier 2, the requirement is around 8% of the total risk weighted assets itself. And just to differentiate between tier 1 and tier 2, there has been an interesting usage. Tier 1 is looked at as a going concern capital, whereas tier 2 is looked at as a gone concern capital. What is the difference between these two? Here, this particular equity and the non-cumulative perpetual preferred stock, they absorb the losses when the bank is having positive equity also. Whereas this group, they will absorb the losses when the bank's equity is negative. So even when the equity of the bank is positive, this group can absorb the losses, but only when the bank's equity goes negative, so which means it's nowhere a going concern, it's a gone concern, it has to be liquidated. That is where this group will start absorbing the losses. And even if after this group absorbs the losses, that is when the depositors will start absorbing the losses. So that's the reason depositors have a much better ranking compared to these. So even if this whole group is absorbing the loss, even if this whole group is absorbing the loss, still the depositors' interest could be protected. That is what is the intention behind the computation of this tier 1 and tier 2 capital. And total put together, as I said, they both put together should constitute at least 8% of the overall risk weighted assets. And it is becoming more and more rigorous. The percentages are growing up. The definition of the equity capital is getting tightened, which means every activity that has been taken up by the Basel is targeted towards the strengthening of the banking system, right? And implementation wise, okay, the expectations are the overall by 1st Jan 2015, every bank is supposed to come out with a 4.5% tier 1 equity capital along with a 6% a total tier 1 capital. right? But along with that, by 1st Jan 2018, it's even expected that the new definition of the capital, they have to be fully implemented by the various financial institutions. So this is what is the timeline for coming out with tier 1 and tier 2 capital, right? Now, the next thing, looking at capital conservation buffer, something which is being set up. Capital conservation buffer, that is again a kind of a preventive mechanism along with a counter cyclical. So first let me look at the capital conservation buffer. This is primarily targeted to protect the banks from a financial distress, especially during the stressed scenarios when the economy is in a state of financial distress. It is primarily targeted to protect the banks. What it is clearly saying is, now the banks have to typically maintain a buffer of 2.5% of their risk weighted assets as a part of their tier 1 capital. Means the total tier 1 equity capital now is increasing from 4.5% to 2.5%, which is increasing up to 7%. And in a way, even the tier 1 plus tier 2 put together will increase from 6% to 8.5%, and overall capital also will increase from 8% to 10.5%, especially during the normal periods. Right, during the normal period, this is suggesting that the banks have to maintain a buffer of 2.5% of the risk weighted assets, which will play a role in terms of covering the losses, especially during the stressed periods, because during stress periods it is difficult to raise capital, right? It is difficult to raise capital during the stress period, and that is where whatever is the capital that is getting raised during the normal period, it is used as a buffer to typically protect the bank during the stressed period. So it is purely acting as an extra cushion, and it is becoming a mandatory requirement as a part of the capital requirement itself. And so the implementation wise, probably there is a phase wise implementation. Right from 1st Jan 2016, this process is starting, and at the rate of some 0.5% every year, this process has to be completed by 1st January 2019, by when every bank should have a minimum of 2.5% capital conservation buffer. And during the stress periods, they can withdraw from that particular buffer. But when they are withdrawing from that buffer, now this is where parallelly there are some dividend restrictions that have been set up. Right? They are withdrawing from that particular buffer, but at the same time dividend restrictions are coming up with, say, minimum of some percentage of the earnings have to be retained. There is a cap, or there is a minimum of retained earnings that the bank has to do depending on what is the capital conservation buffer, or probably the tier 1 equity capital including the buffer. Let's say if it is above 7%, even after they have withdrawn, let's say tier 1 capital including the capital conservation is above 7%, they don't need, they have nothing to do as a retained earning. But if it is, let's say, from anywhere between 6.375% to 7%, it has fallen below 7, then they have to retain minimum 40% of their earnings. Like that, if it is anywhere between 5.75 to 6.375, they have to retain minimum 60% of their earnings. And if their tier 1 capital is somewhere around 5.125 to 5.75%, they have to retain 80%. And if it is anywhere between 4 to 5.125%, it's mandatory that they have to retain the entire 100% and they can't pay any kind of dividend. So this is what is the objective of capital conservation, which means overall the tier 1 capital is going to increase not just to 8% now. Our tier 1 plus tier 2 is going to increase not just to 8% of the risk weighted assets. Now it is going to touch even the 10.5%, and that too specifically tier 1 equity capital is going to touch somewhere around 7%. Tier 1 plus tier 2 alone is going to touch a minimum of 8.5%. That is where the stringency is coming up in terms of the implementation of these buffers. Then there is one more thing that is coming up in the same context, another buffer, but this is more and more not that mandatory. It has been left to the discretion of that particular country. Countries' regulators, they can take a call whether they want to implement this additional buffer or not. This is primarily a protection against the cyclicality of the bank's performance, protecting against the cyclical nature of the bank's profits. So in periods when the profits are much higher, the buffer needs to be set aside so that when the performance of the bank has gone down in one cyclical period, this buffer can act as a cover. Again, this is said that this can vary from 0 to 2.5% over a 4-year period. 1st Jan 2016 to 2019 is the period during which this has to be met. And the same restrictions, probably dividend restrictions, all of them can come into picture. So it is looked at like anywhere the tier 1 capital between 4.5% to 5.75%, a mandatory 100% of the dividend needs to be retained. But if it is anywhere between 5.75 to 7%, 80% of the earnings need to be retained. Only 20% can be paid in the form of dividend. 7 to 8.25%, 60% has to be retained. 8.25 to 9.5%, 40% has to be retained. And in case even after the withdrawal of these buffers, you see that the tier 1 capital is above 9.5%, then the bank has the flexibility in terms of distributing the dividend. Right? So this is what it has really brought around in terms of the capital requirement, tightening the capital requirement, including the definition of the capital as well. That's one major dimension that Basel III has targeted. Along with that, there is an increased focus on liquidity risk, right? Another major dimension which has been focused by the Basel III is towards the liquidity risk. So in that context, it has brought out a minimum leverage ratio. Right, one basic calculation that it has brought out is on the minimum leverage ratio, which talks about the capital to the total exposure. The total exposure here, whatever we are referring to, is the on balance sheet as well as off balance sheet kind of entries. So here it could talk about not just the risk weighted, it is all elements on the balance sheet, and even the off balance sheet elements like any kind of commitments that are there, even they would be included as a part of the total exposure. And if I look at the traditional way the banks do the business, they have long term obligations, right? In majority of the cases, they have long term obligations that are met with short term funds. You see here regularly also, deposits are the major source of funds with them, but they typically use these deposits and short term funding kind of mechanisms to invest in long term obligations like loans, where they will get the benefit only in a longer periods, or where the payment on the loans is going to be much longer. Or a simpler way to look at, the long term assets and the liabilities are more and more short term in nature. Now this kind of a mismatch, as long as the economy is good, as long as the recessionary kind of a situation is not coming up, this mismatching is pretty much fine. Otherwise, the liquidity here gets dried up, and that is what is giving rise to liquidity risk. Whatever are the short term sources of capital, they are not getting rolled over. Right? Anything that has been borrowed on a short term basis, they are not able to roll it over to the futuristic period. That is what has happened for majority of the banks, including the Lehman Brothers, during the financial crisis. So the major reason was the liquidity risk rather than a credit risk during the financial crisis. And that is where the Basel started focusing on the computation of two key ratios that were introduced. One, it has brought in what is called as a liquidity coverage ratio, and the other one is the net stable funding ratio, NSFR. So liquidity coverage ratio is majorly targeted towards a 30-day. To what extent the bank can withdraw, our bank can really withstand the 30 days of disrupted liability, even if the disrupted liquidity, even if the liquidity is disrupted for a 30-day period during a year. Does the bank have the sufficient liquid assets? This is where it is bringing out the liquid assets, how sufficient they are to meet the liquidity requirements of the bank even for a 30-day period. Now this kind of a stress is a much bigger stress. Probably this is more and more equivalent to a 3-notch downgrade. So within a 1-month period, it is as good as if the downgrading of the rating happens by three different layers. Let's say from a AA to A. Such kind of fall also can be withstood. Along with that, if the deposits are getting lost heavily, any of these scenarios, the bank should be in a position to withstand that. Even if the collateral that has been used for various fundings, even if the value of that collateral has gone down, any haircuts on the collateral that has been used, even if they increase drastically, the bank should typically be in a position to withstand this entire cause of liquidity. That is where it is bringing in the liquidity coverage ratio, wherein it is clearly bringing out the definition as high quality liquid assets, not just liquid, high quality liquid assets by net cash outflows in a 30-day period. So this ratio should always be greater than 100%. That is the most important requirement as a part of the liquidity coverage ratio. and it has so if this is always greater than 100%, it's an ascent, it's a kind of a assurance that the bank can really meet out the pressures, any of these pressures that are very very significant. And on the other side, it is talking about a net stable funding ratio, wherein the focus is on managing liquidity over a 1 year period, more and more stability. So that is the reason even the formula talks about the amount of stable fund that is available divided by the amount of stable fund required. So we are talking about the required amount of stable fund and the amount of stable fund, the ratio should be greater than 100%. And probably the way I can look at is the amount of stable fund that is required is purely in terms of the assets that it is holding, and amount of stable fund that is available is looked at purely in the form of liabilities and the shareholders equity that is there in the balance sheet of the firm. So what we say is, for each source of funding, which is for each element that is present in the liability and the owner's equity section of the balance sheet, there is a multiplication factor. So the amount is multiplied by a particular factor, which is a reflection of the relative stability of the same. Probably if I look at the tier 1 and tier 2 capitals, I look at them as much more stable sources of funding, and even for a debt which is having a maturity of more than 1 year, all these are looked at as stable sources of funding. That's the reason the weightage is given to be 100%. But in terms of, let's say, demand and term deposits from individuals and small businesses with a maturity less than 1 year but they are stable, they will have a weighted factor of 90%. But if the same are unstable, the weightage factor is going to be 80%. Like that, there are some kind of different stages. If it is a wholesale funding coming from any non-financial corporations, central banks, with a maturity less than 1 year, it is treated as slightly more unstable source of funding with a weightage of only 50% associated to it. And any other liabilities that are coming up, they are given a 0% weightage, means they are all unstable sources of funding. The same way, there is a kind of a tabulation that is going with respect to the required sources of funding also. I mean, the required funding requirement, required stable funding. If I look at, again, there is a factor which talks about relative permanence of the funding required. So especially like cash and the asset side now, cash and short-term securities, the all these which are very less than 1 year kind of a maturity, there is no weightage that is applied on them. But any marketable securities like treasury bonds and all, which are having a maturity of more than 1 year, there is a 5% weightage that is applied. Corporate bonds, if you have if you have invested in corporate bonds which are having a credit ratings of AA minus and higher, right, much better high quality corporate bonds, the risk weight is around 20%. But if you are going with gold investments or equities or even the corporate bonds which are having slightly lesser credit ratings, A plus to A minus kind, there is a weightage of 50%. Any residential mortgage investments, they carry around 65% weightage. any loans that are provided to small business or retail customers, they are carrying around 85% weightage, and all other fixed assets typically carrying around 100% weightage with respect to the stable funding required. So simply available stable funding divided by the required stable funding is what is providing the overall ratio of greater than 100%, and that is what is an assurance that at any point in time the bank is having enough stable funds to meet all its requirements even if the situation goes worse in any of the from any of the dimension. Now implementation wise, the liquidity coverage ratio is expected to be implemented by 1st Jan 2015, whereas net stable funding ratio is expected or scheduled to be implemented by 1st January 2018. Right? Then one more instrument that is worth looking in this context is the contingent convertible bonds, which are in other way called as COCO bonds. These COCO bonds, they are like convertible bonds only, right? Probably there is a small difference that exists when I compare them with the traditional convertible bond. They are converted into equity, but they are not at the discretion of the investor. They are converted into equity automatically. Why is this automatically, and when? Primarily when that particular issuer, which is the bank, is experiencing financial strain. So during that period, the debt instrument is getting converted into equity, which means as long as the bank's performance is better, as long as the economy is doing much better, it is still remaining as a debt only. And mandatorily it is getting converted into equity, which means there is a cushion against the bankruptcy, the loss that can come out, right? Because it's an automatic conversion into equity. So there is a kind of cushion against the bankruptcy, preventing the insolvency of the system, which is also another indication that whatever is the capital that is needed to be maintained, it is typically provided by the bondholders, not the government and the traditional taxpayers. And the bailout possibility will be very much, bailout possibility can very much be avoided because of this. So we see that in the today's scenario, the COCO bonds will really have a much better or much wider usage. The demand for them is going to go up quite drastically. So whenever we are seeing the events wise, if the tier 1 capital ratio is going down, they can be triggered. And if at all the supervisor, the supervisory firm typically judges that the bank's solvency is at risk, then immediately this COCO bonds can get converted from debt to equity. And if the bank's market capitalization to the assets ratio is much lesser, even in that case the bonds can get converted into equity, and finally this ratio can be improved. So there is a huge demand that can crop up, especially with the kind of restrictions that are being brought out in the capital requirements by Basel III. It is very much expected that the volume of these COCO bonds is going to go up drastically in the next 1 decade. So all these things have been very much brought about by Basel III, with prime focus being the capital, strengthening of the capital, tightening of the capital, bringing out more and more requirements to tier 1 and tier 2 capitals, and also focusing very heavily in terms of liquidity risk management. Right? All right. Now let's talk about the Dodd-Frank Act, which initially started as a set of recommendations made by this committee, which was signed into law on 13th July 2010. The main intention, or whatever are the various proposals that are there as a part of the act, are targeted towards protecting the various consumers, whether it is the retail consumers or the investors in the financial markets, and make sure that the future bailouts, like the case of various banks that have happened during the financial crisis, the future bailouts are completely prevented for both the banks as well as any kind of financial institution. So it is trying to come out with, it has come out with a very good set of guidelines which are targeted towards the protecting the interests of the consumers as well as the preventing the future bailouts and the collapses of the banks and the financial institution. So majorly targeted towards, probably you can look at it like a kind of regulations that have been very much strictened, strict regulations that are associated with the banking system. So that is what is the essence of the Dodd-Frank Act. Let's see some of the salient features of that. If I look at, there are a few bodies that are established. There is something called Financial Stability Oversight Council, FSOC. This is established as a part of the recommendations of this team. Along with that, there is also Office of Financial Research, OFR. These two committees, when I look at the first one, FSOC, their job is more or less monitoring the risks that are there as a part of the entire financial system. Right, probably systemic kind of risk they have to be on a constant search out for, and their target is majorly in the entire financial system, looking out for various opportunities where there is a possibility of a systemic risk. Whereas on the other side, when I am looking at Office of Financial Research, they are researching on the current state of the economy and majorly identify those risks which can affect the financial stability in the country. So majorly targeted again towards improving the investors' confidence and at the same time improve the market discipline also. So their major job when they are working together on various aspects, their major job is to come out with identifying the CPs. What are these CPs? They are systematically important, system-wise, systemically important financial institutions. Means if they break down, the whole financial system could collapse. They have a systemic impact. They have a systemic impact on the entire economy and the entire financial system of the country. So the job of these FSOC and OFR is to identify these kind of banks and financial institutions. And probably in United States, it's quite a simpler rule that have been said. Any of that bank which is having a total assets which is greater than $50 billion, that gets qualified as SIFI. But at the same time, for a non-financial or non-banking based financial institution, no such direct linkage in terms of the assets has been set out. Now, once a few set of banks are being identified as the SIFIs, they have to really come out with a plan. That plan should clearly chalk out in case there is a failure in the overall financial system. How would they typically emerge safely? If there is an overall failure in the financial system, how can they emerge safely from it? And they have to come out with that kind of a plan. And in case they are not able to provide an acceptable kind of a solution for it, even if the banks that are considered as too big to fail, they would be broken up. Very, very stringent move. Right? Every financial institution which is identified as a SIFI, it has to come out or check out a plan that in case a big failure occurs in the economy, in the system, how would they typically safely wound themselves? If they are not able to wind themselves, or if their winding is not satisfactory, then probably they can very well be broken up. And even additional capital requirements can be suggested apart from the regular capital requirement. Additional capital requirements can very well be suggested for these SIFIs. So that's one more important recommendation that has come from the Dodd-Frank Act. Along with that, the Federal Deposit Insurance Corporation, right, which is typically called as FDIC, the power of it, especially with respect to the liquidating the banks in order to protect the interests of the consumers, has actually increased. Now what they can do, they can take over the banks. Now the FDIC can actually take over the banks, and it can take over the large firms and sell their assets. And once they sell it, especially they sell it to the creditors as well as to the shareholders, which means the loss is actually absorbed by this community rather than the general public. Instead of, see, if there is a bailout that is happening, the government is actually funding for the same. And if the government is funding, actually it is the general taxpayer who is bearing these losses. So what is expected is, in case any of these large firms are failing, the assets of these have to be sold back to the shareholders and the creditors, which means the financial industry will bear the loss, not the regular general taxpayers bearing the cost of the failure. And even the FDIC's deposit insurance has been permanently increased from $100,000 to $250,000. One more important move. And coming to the other side, hedge funds. Probably one major thing which we differentiate a hedge fund from a typical mutual fund is with respect to the reporting requirement. Right? Hedge funds are not that regulated. The reporting requirement is not heavy for them. But now the Dodd-Frank simply says now even these firms need to be registered with the SEC, and the reporting requirements are enhanced even for them. Then comes, with respect to the insurance industry, there is a federal insurance office which has to work with state insurance offices in terms of monitoring the entire insurance industry looking at the way AIG has collapsed. So there is a federal insurance office that has been set up, which has to work with the various state insurance based regulators and monitor the entire insurance industry. Apart from that, one striking fact is a Volcker's rule, which clearly talks about a bank, a kind of an institution like a bank, which actually takes the deposits from the customers. Now, these kind of institutions, which are accepting the deposits from the customers as a main source of funding, they should not get involved in proprietary trading kind of activities. Now, this is where probably it could not differentiate between the speculative trades and hedging trades. Probably if they are hedging based trades, still it is beneficial for the banks. Only the speculative trades could have been banned. But here the rule is completely putting a hold on the banks, completely not getting involved with any of the proprietary trading activities. And any specific financial firm, if it is getting into any kind of high risk trading activity, high risk trading activities, probably it needs to spin off, right? That particular operations, they need to be spun off as separate different capitalized subsidiaries. So one more stringent requirement, you can't link both of them together. Both of them together cannot coexist. That is one more important point that came out. And especially with the OTCs, again, the regular lookout with the OTC derivatives, over the counter derivatives, is the regulations are much lesser on them. They are more and more customized. Now, here also, all those standardized OTCs, the standardized swap agreements, standardized forward contracts, it says that now they can be cleared not bilateral, but again they can be cleared either through exchanges or there are centralized counterparties which are doing this process. And there are also a few of them like swap execution facilities, SEFs, that have been set up and that have been mandated. And the entire thing is monitored. All these institutions are typically monitored by Commodity Futures Trading Commission, CFTC. Commodity Futures Trading Commission is monitoring all of them. And a clear-cut trade repository for all of them is getting maintained. All the trades that have been executed, initiated, a big repository for the same is getting maintained. And it is becoming an important requirement for the Federal Reserve to come out with clear-cut risk management standards, especially for those banks which are heavily involved, which are like SIFIs, which are heavily involved in clearing, settlement and payment kind of functions. Now coming to the other side, with respect to the rating agencies, there is a very strict imposition on terms of rating agencies now. They have to very clearly, transparently disclose the assumptions and the various methods that they have used for arriving a particular credit rating. So again, regarding that, there is an Office of Credit Ratings, OCR, has been established for the same, and even the rating agencies, the legal liabilities, especially with respect to the failures, has been considerably increased. And at the same time, with respect to the banks, it has come out that using the external credit ratings, right? External credit ratings for setting the capital limits is banned. Now this is where Basel has to really work, because Basel 3 also has used a lot of, especially for coming out with a comprehensive risk measure, it has a direct reference to the credit ratings itself. So the Basel 3 has in fact used the external credit ratings, whereas the Dodd-Frank has clearly come out that the use of the external credit ratings for setting the capital requirements is completely banned. And on the other side, there is a Bureau for Financial Protection that is created within the Federal Reserve to ensure that everyone, all the customers, they really understand their loans, their credit cards, their mortgages, whatever the details, provide enough clarity on the various products, right, to make sure that they are receiving clear and accurate information, right. That's very important, because as a part of the marketing activities, the banks and various financial institutions are talking all kind of rubbish to really promote their product, and enhancing the clarity to the customer in terms of the products that they are buying is very much essential, right. And compensation structure, coming to the corporate governance activity, it is clearly saying the compensation structure, which is typically decided by the board for the various executives, it should contain majorly independent directors only. And at the same time, this compensation should not be directly linked with short term goals. So, because if more and more short term goals are there, the risk taking nature is going to increase drastically, and this is what has to be discouraged. And in this context, even the shareholders, they are getting a non binding vote with respect to the executive compensation packages. That's another important move which is strengthening the corporate governance activity also. And for the banks, okay, if they are securitizing any of their assets, it is also saying that a minimum of 5% of their assets they have to retain. And finally, from the banks, there is a responsibility that they are allocating to the banks. You have to clearly assess the borrower's ability to repay. When you are giving a loan, you have to very clearly assess the borrower's ability to repay. Only after that you have to go for settling a loan. You can't do all kinds of subprime mortgages, right? And if at all you did not do a proper assessment of the borrower, and after that you are trying to foreclose that particular loan, the foreclosure is strictly not allowed. If the bank did not put enough efforts in terms of assessing the credit worthiness of the borrower and it has given the loan, it cannot foreclose the loan. And finally, again, as a part of the strengthening of the corporate governance activity, it says that at least one board member should have a very good risk management experience with a very large, complex organization. All these things, if you see, it is strengthening the financial system, trying to make that the risk management is effectively implemented across all the stages in the financial system, and making the banks more and more responsible and accountable towards protection of the needs of the depositors and the various consumers. And it is finally targeted to make sure that the overall banking system, overall financial system does not collapse, and it need not be bailed out through the funds of the typical taxpayers. Right?